What's up, guys? My name is Chris, and today we are talking about the dreaded student loans. They suck. They really do. That being said, they are important, unfortunately. So it is something to at least understand and be aware of in terms of how they work, what they mean for you and your future. So that brings us to our video today. Just spreading some knowledge. So let's dive in. We're going to talk about how student loans work. So student loans, essentially, are comprised of two main components, that being principal, the amount you owe, interest rates, the cost of owing. And I feel like principal is probably pretty intuitive if you get a student loan, or any loan for that matter. For no one would ever do this, but a loan for like $100, that's how much you owe. Plain and simple. Now, interest rates can be a little bit more complicated, at least on the surface, but hopefully by the end of this video, you'll learn something. So for interest rates, there's two types. There are simple interest rates and compound interest rates. We're going to talk about simple interest rates first. And most loans will not have simple interest rates, but understanding what they are at least gives us a basis for understanding how loans and student loans work. So simple interest rates mean you can only gain interest on the principal. So in this hypothetical, where we have a principal of 100, so that means you owe $100, you drew a student loan, the bank was like, hey, we'll give you $100, and you were like, yes, give me $100, because you wanted to buy, I don't know, a fifth of a PlayStation 5. And you have sorry for that joke, an interest rate of 0.1, which is a 10% interest rate right here. What this means is, in terms of a monthly interest, you are dividing your yearly interest rate by 12. And I'm doing a monthly interest as opposed to a daily interest rate, as opposed to a daily interest rate, just so I can stay high level and not have, every day of the year modeled for the next 300 cells. So we're just going to do a monthly, assuming a monthly payment plan. I guess in this hypothetical, you are not paying anything. This loan is just accumulating over time without any payments being made. So when that happens, every month, this 0.83% is being multiplied by this $100 principal, on and on and on and on and on and on and on. And this principal adds that money plus its previous amount every month. So this 101.67 is F7 plus G7. So it's these two things being added, and that just happens over time. So that's simple interest rates. The interest you gain remains consistent. On the other hand, and this is a more realistic example, compound interest rates are, that's not right. You can gain, interest on your interest, which sucks. This is how people screw themselves over and get themselves in a hole, because it just increases more rapidly over time. So here, again, we have the same constants, $100 on the principal, the amount you owe, the 0.1 interest, that expressed as a percentage is 10% interest, and on a monthly payment or a monthly compounding situation, you're dividing this by 12. So here we have the initial principal and the initial interest payment. Notice how this is the same, because interest hasn't, a financial term that people will use is accrue. So you accrue interest over time, essentially accumulate or gain, synonymous with. So this amount, you add these two, which again, same as simple interest rates. But for this interest calculation, you are applying this monthly interest rate times your previous principal. Now, this was not occurring in our simple interest rates because no matter what month, all the calculations are the same. We just multiplied our monthly interest times our principal, and that was that. But now we are multiplying our monthly interest by the current principal at hand. So over the course of a year, your interest gains 8 cents. It's a lot of cents. So that's that. You gain interest on your interest. So that's something to definitely be cautious about, because most loans that you have, whether it's student loans, whether it's credit cards, drawing out a loan on monthly car payment plan, a lot of times they will the loans that you do get on those things are going to be compounded most likely on a daily or monthly basis. Simple interest rates aren't too realistic, but again, something important to know. Next, on to the student loans. So this is a basic, let me get rid of these numbers so that people aren't scared. All right, student loans are scary enough. Boo! It was actually supposed to be like a boo. But it also could be a scary like ghost, like boo. It works. So here we have no numbers, but let's apply what we learned. We have $1,000 principal. We're not paying anything back, and there's no interest accruing, so this 1,000 just remains the same over the course of time. But we now have a 0.2 interest rate, so a 20% interest rate that expressed in monthly terms, which again is our interest rate divided by 12, is going to be right here. So the 16 figure, 16.67, is monthly interest as percentage times our principal. And that is then, now this is a hairy formula because I added some conditional formatting here, but you can ignore that for now. Essentially, this is going to be that plus this. And it's not exactly showing the exact number, and that's some compounding formulaic things that I adjusted here. But don't worry about that. But essentially, that's how that works. So every month, we'll say you are paying $500 on your student loans. Let's do $50. That 50 is going to be dispersed amongst the interest and the principal payment. So priority one is the interest, and whatever is left over is going to go towards your principal. So your next outstanding balance is going to be this number. This number minus this number is going to equal that number. And that just keeps on going on and going on and going on. But something to note, and I want the biggest takeaway here is this interest rate, 0.2 or 20%, is not what you're paying every day or every month or every week or whatnot. This is over the course of a year. Now, again, it can be a little bit more nuanced than that because of the whole simple versus compounding interest rates. But that comes down to figuring out how your student loans are being compounded. Now, I believe most federal loans are compounded on a daily basis. How are federal loans compounded? How often are federal loans compounded? Even though federal loans are expressed as annual rates, the interest is usually compounded daily. So that's the case for federal loans, and most likely for student loan or private student loans as well. But again, that can vary from place to place. But most often you will see a daily compounding student loan situation. Now, because for this example, I kept it as just a monthly interest, this would not be the same modeling for those loans, because these are being compounded monthly. These federal loans are being compounded daily. So that's the difference there. But I'm trying to think if there's anything else left to talk about. Yeah, I mean, that's about it. That's the major takeaway. So if you have any questions about that, how student loans work, if if something didn't make sense, let me know. If there is future topics I can cover, federal versus private loans, the pros and cons of each, anything like that, or different strategies to make student loans easier, or lower your interest rates so you have to pay less, or strategies for general payment, just let me know, and I can maybe be of assistance, make some future videos. But other than that, thank you for watching, and have a good day. If this thing will cut off.